So hi everyone, this is Fred Sroka. I'm here with Professor Del Hutchinson. And Del, you and I have both worked with a lot of corporate clients. We've dealt with the wonderful attempts to give incentive compensation out to employees and
Yes.
the tax complexity that comes along with it. What we're hoping to do in this recording is capture some of the practical experiences, go back through the tax rules, but not so much teach the taxes, talk about how different plans are impacted by tax and how you design them to try to achieve your business purpose. With that said, let's begin with the basic rules. Del, could you walk us through what it is to give stock and stock options to your employees?
Okay, folks. Well, first of all, again, as well, I echo my thanks for you joining us. And so we're now looking at slide number 2 that reads stock and stock options. So I guess we just start really with, why do we care? What's the business issue that we're confronting here? And in my experience, employees perform better if they have some sort of a value, some sort of a interest in the growth of the company. Now, exactly how you do that can be difficult. Fred, what's been your experience? Is this really being used consistently? What are people really doing out in the market?
I would say that tech companies routinely give equity away. But I represented a tech company that was close to going public, wound up getting acquired. The founder said, look, we're willing to sell out to that big East Coast publishing company at this price, but we have to preserve the stock option plan. The response from the buyer's attorney was, Fred, my client doesn't do business with communist organizations. So I'd say it varies, but clearly tech tends to try to provide incentives for everyone to work together. I would say that more traditional businesses probably don't provide as much, although we still see some plans coming in even there.
Okay. So if your clients are tech companies, then this is definitely all about you. I know in my experience, I've seen some non-tech companies that have gone through some sort of amazing hoops to try to get an incentive comp in there. So that said, let's talk about the rules. So first of all, we'll talk about stock options. What you see is many employers are granting stock options. And so let's just talk about some of the key concepts, and I'm sure many of you are already aware of this, but just to kind of lay the foundation here. A stock option, there's an exercise price. The exercise price is the price at which the employee can purchase the stock that's represented by the option. It's usually fair market value on the date granted, and the way the book rules work nowadays is it really adds a lot of good reasons to make it be fair market value, never mind the tax rules. Vesting period, concept, how long the particular employee needs to stay in order to earn the right to vest in those shares. GAAP reporting or book reporting. So for financial statement purposes, the value of the option is treated as compensation spread. They measure at the time that the option is granted, and that compensation is spread over the period and charged an expense over the vesting period.
So for financial accounting purposes, we say when I give the piece of paper, the option right to my employee, that's when I'm making them richer, right? And then I should match, if that's over 4 years that it vests, I should pick up the expense, whatever that piece of paper is valued at 4 years, a quarter each year.
And of course, as you know, or are going to see from this discussion, what the book comes up with and what the tax comes up with is often radically different. So definitely an area of interest for those if you have companies that are providing some sort of a incentive compensation. So for tax purposes, the last bullet now, Code Section 83 requires that any stock or property which is granted in connection with the performance of services is treated as a taxable bonus, in effect, to the extent the value of the stock exceeds the purchase price. This bargain element is measured on the later of the day the stock is acquired or the date the stock vests. Fred, how can it be two different dates there with respect to these programs?
Both financial accounting and tax reporting try to do the same thing, saying if you give your employees valuable stuff and they don't pay full fair market value for it, you've given them a bonus, a make-believe bonus, and you should show your comp expense and they should have that income. The difference is financial accounting, US GAAP, says that piece of paper that gives the right to the option, that's the thing that makes the employee richer. Tax is a little bit more precise and they need a very clearly identifiable event. Tax treats that piece of paper, the option, as just a promise to give you stuff in the future. Well, usually you have to work, let's say, the 4 years, and then you can go ahead and say, now I want to exercise. Some plans do let you exercise early, so you pay money for the stock, but it's not vested yet. And again, the IRS looked at that and said in the 83 regulations, no, we don't think you're really the owner of that stock unless you get to keep all the appreciation in it. So that's why Section 83 says that you measure the bargain element, which is the additional income to the employee, the deduction to the employer, on the later of those 2 dates. You're holding on to a stock option, it could be worth a fortune. It could be stock options in Google, but there's no income tax. However, if you exercise the option and you get the shares and you're entitled to the appreciation in the shares, that's the day that tax says, let's say you're richer, let's measure the value of it then. So,
wow. Why wouldn't you always want to have stock options? Sounds great, especially if they're Google options, right? Is there ever, just like financial risk to an employee, especially if they maybe have a stock option that they've been granted, that's vested? Is there a risk? They're going to pick up income. Is there any risk to the employee in that situation?
Just holding the option itself, unless there is a public market for the options, which almost never exists, the answer is there's no income tax consequence to having the option. When we talk about this when I talked about it with my clients, I'd routinely refer to incentive stock options called ISOs. Pretty much all other options are called non-qualified stock options, right, or non-quals. And then I made reference to what were called SCUBAs, and my clients would get confused and say, what's a SCUBA? And I said, it's a stock option that's underwater, meaning the fair market value is well below the exercise price. So I think the only downside for employees is if you think you're working for equity in the company, but the stock price doesn't exceed your exercise price, there's nothing really there. You're just hoping for the future, and maybe you're working hard now, but you'll never get the brass ring.
Okay. And folks, we thought it was important to just talk about that concept because we're going to see that the way it works out with some of these other potential incentive compensation arrangements can differ with respect to how it affects the employee economically. So let's move on to the next slide, which is about restricted stock grants. And a restricted stock grant is a grant of restricted stock. So the actual date of the grant, it's not taxable. But when that stock then vests, then the bargain element is treated as a cash bonus, in effect a cash bonus, followed by purchase of the stock for effectively that bonus. Now, there's also this concept of an 83B election, and I know there's a lot of confusion out there about when you can make an 83B election and when you can't make an 83B election, how you do it, and what have you. And we're going to talk about that. But with respect to a restricted stock grant, you can in fact make an 83B election.
Right, because your boss gave you a stock certificate, so it's really property. Right? You hold it, but you have a substantial risk of forfeiture, meaning if you don't keep working for the next 3 or 4 years, you're not going to be able to keep the appreciation in it.
So, folks, that's maybe it seems like a distinction that doesn't make a difference, but that's the way it works in the tax side. So let's take a look at this example. So the slide shows you an example of a situation where a director who is compensated partially or wholly by receiving an unvested stock option at $4, and over a period of time, often 4 years, the stock vests. And in our example, we're going to say that at that time, that stock, which is probably some sort of a public market stock, is worth $10. So the bargain element of that $10 is treated as ordinary income upon vesting. So what's the bargain element? Answer: it's the difference between that $10 and the amount that's paid or has to be paid for that option.
Exactly. And then we do see that what happens is the employee in that example would pick up $10 of ordinary income. So it's like on the date of vesting, the employee got paid $10 cash as a bonus, turned around and bought the stock, so they have basis at $10. And then the appreciation beyond that is capital gains, right?
Right. So let's focus on one thing important now. We said before an 83B election was possible. So what if we make an 83B election? How does that change our results here?
Well, what Section 83B allows the service provider to do is say, I want to pretend for tax purposes only that there were no restrictions on my ownership, that my stock was vested the day I got it. It's a pretty tight time frame. You get 30 days after you receive the stock to actually say, I want to make this election, send it to the IRS and copy your boss with it. But why would you want to do that? You pay tax earlier. In this case, the director would have to pay tax on day one when the stock certificate was granted, because he has the stock certificate, and for tax purposes, we pretend that it's fully vested. So the employee would pay tax on $4 right up front. Now, paying tax early sounds crummier than paying tax later, but what happens then is the employee is treated as having gotten a $4 cash bonus, bought the stock certificate for $4, so he has a $4 basis, and then all future appreciation. First of all, there's no tax event on vesting, which is kind of a nice thing, because when you think about vesting, you don't get any extra money. All the rest of the tax, all the appreciation above $4, gets taxed at capital gains rates when the stock certificate is actually sold downstream.
Okay, so the 83B election can be helpful, even though you have to get it into your wallet right away. So let's continue looking at this example for a second, because there's another issue that you can run into. So let's say that what we're looking at numbers here, that's $4 and $10. Let's just add a few zeros to make it interesting. Let's say that there's a lot of options, and the total value at the date of vesting is $4 million, or the date of issuance is $4 million, and that the total value on the date of vesting is $10 million. Let's say that the decision is made by the director in this case to receive the stock at the date that the stock vests, and you pay tax on that number. Any economic risk of doing that, Fred?
Yeah, a decent-sized economic risk. So the director's saying, I want to pay tax today on $4 million, and that's ordinary income. So what's that going to be? Maybe $2 million in tax? And then God forbid the company tanks. But if the company tanks, you have pretended for tax purposes that the director got a $4 million cash bonus, turned around, bought the stock. If that goes down to zero, that's a capital loss of $4 million in some future year. So the $2 million tax that you paid on the ordinary income, that's just sunk money, and lots of luck using that capital loss way out in a future year.
Okay, folks, we're going to move on now to restricted stock units issued to service providers. That's slide 4. So what's a restricted stock unit? An employer makes a promise to deliver shares in the future if vesting requirements are met, and the shares are then delivered as this vesting requirement is met. And what we've seen in the market is that, at least here in California in the Valley, that 4 years is pretty common. Under a restricted stock unit, the employee recognizes effectively a deemed bonus based on the fair value of the stock when received, so essentially a cash method pickup. But unlike restricted stock grants, there's no possibility of making an 83B, and then of course once you've picked up that income, your future appreciation becomes capital gain. So Fred, help us. Why no 83B election in this situation?
Well, when we talked earlier, Del, about the stock option, again, the IRS views a piece of paper that promises to give you the stock in the future as not being the thing itself. So that's not the right time for tax. They're trying to be nice. But in this case, you got a piece of paper saying, if you stick around 4 years, I will give you the stock certificate. So the tax law says, sorry, you don't have the stock certificate in your hand. You have to wait until you get the property and then see if it's vested. If it's unvested, then you have to make an 83B to pay tax then.
So, folks, There is an example on the slides you can see, and on our example, the company promises to deliver stock to employee upon vesting, and if in our facts, similar to prior facts, it's worth $10 a share at the time of delivery. Then the entire $10 bargain element is picked up, and the future appreciation above that $10, it can be taxed
Right, and
as capital gain.
since it's fully vested on the date of delivery, there's no need to make an 83B at that time, right, Del? It's just irrelevant. You got the stock certificate. You recognize your income no matter what.
Yeah, it's a closed transaction. But I still think we had to each time consider, is there economic risk to an employee when they receive the right on day one to have future restricted stock units in the future?
Again, I would say with the RSUs that there's no tax risk to the employee. If you never get the stock certificate, you never had any income tax, your boss never got a deduction. But it's the same thing of maybe you're going to work a little bit harder, and if the company tanks, you're never going to get your reward. So no tax risk. There is kind of a crummy thing, though, Del, which is that it's kind of like forced savings, meaning when you get handed that certificate, you might have to pay a lot of tax. In your example, you said put $1 million after it, and boy, if you have some poor employee who now needs to pay tax on $10 million worth of ordinary income, they have to come up with $5 million cash. That could force them to have to sell the stock certificate, which kills off the long-term co-investment that their boss wanted to begin with. So I'd say, yes, tax is a factor that really does impair the use of RSUs, but it's the disincentive of taxing people when they get stuff as opposed to when they sell stuff.
So let's just think about a further example. Let's say that somebody who's maybe been at the company for a really long time, but maybe had a fairly low level position, but came in effectively shortly after the founders, got some really nice stock position. The restricted stock units are delivered, and hooray, but the person doesn't move on it at all, and come around the next April 15th, and all of a sudden the need to pay the tax. What happens if the stock has moved down in value?
Boy, what's so frustrating is you've got the income measured back in the year that you got the stock certificate. And we have seen tech companies decline dramatically in value. And if the value of the stock drops by more than half, basically you're broke, the government gets all the money.
And if it drops by more than half?
You get very, very angry at your tax advisors and your boss and at life in general.
So, we're making light of it, folks, but I certainly have seen this situation come up, and it's not pretty. So, if you've got any kind of incentive comp, you really have to make sure that you're dealing with your tax provider, or you need to deal with your clients, depending on which side of the table you're sitting on, and make sure they don't let some economic shift take something that's supposed to be nice and turn it into something that's not nice.
Exactly. And Del, if we move on to slide 5, I think a lot of employers got frustrated not just because of the fact that the tax law gets in the way of giving your employees equity, but also, it really clutters up the ownership of your company, right? If you've got a lot of employees or maybe former employees that you have to give all your shareholder information to, it's harder to control the future of the company. So some employers simply say, the heck with it. What I'm going to do is create a phantom stock plan. What it means is I'm going to give you the same thing as though I was going to give you a share of stock, but instead I'm just going to write you a check equal to whatever the money the stock certificate would be worth if you got it on that date and then you sold it. Now you can do two different things from a business perspective. You can do exactly what we just talked about, where the employee gets the full stock certificate, like with an RSU. That would mean that you'd pay a $10 bonus if that was the fair market value of the stock certificate. Or you can make a stock appreciation right look more like a stock option, which is called an appreciation only plan. And then if it were a stock option, you would have said to the employee, pay me $4 and I'll give you the $10 certificate. The bargain element would have been $6. So in an appreciation only phantom stock plan, the employee would pick up a $6 bonus that gets paid. There's some whereases that say make sure you pay that bonus pretty quickly after it vests. But because the employee never receives stock, they've just got additional money in their W-2. They've got the cash to be able to pay their tax. There is no Section 83B election to be made because there's no unvested property. There's just the promise to get a bonus in the future, and the tax is identical to any other discretionary bonus you might receive from your boss.
So I've also experienced stock appreciation rights with companies I've served in the past. I will say, and had dealing with employees of those companies, they sure know how it works. Unlike so many other types of plans, there's can often be confusion, and 83B, no 83B. At least once it's been explained once, all it is you're going to get money at a certain point in time, measured by a formula which happens to be tied to the value of the company. It's actually can be pretty clean.
Agreed. It doesn't achieve what the employer wants, which is long-term co-investment. It doesn't get the employees really bought into the company as much. But I think you and I have both seen, in a lot of cases, employees either have to or want to sell the stock certificate as soon as they get it anyway.
Right.
So achieving that long-term investment can be really, really hard to do.
So let's move on to non-qualified stock options. And folks, we're now on slide 6. So what's a non-qualified stock option? So a non-qualified stock option is essentially just a grant of options to an employee, and they're generally, again, similar to some of the previous programs we've talked about. They're subject to some sort of a vesting. Of course, the idea is to keep the employee just staying on for a period of time and incent them to really work hard to make the company go well. When NSOs are issued, there is no tax at the time of the grant. The exercise is treated as though it were a cash bonus followed by a purchase. So it's deemed cash in and then cash out to the employee. And the bonus is measured and taxed on the later of when the option is exercised or the stock vests.
So that's the perfect case. If you could exercise the option before you vest, a lot of plans will let you do that. So you pay $4 for the stock certificate, but if you quit or get fired before it vests, you got to give the certificate back. Maybe your boss gives you back the $4, but you don't get any subsequent appreciation. That's the perfect case for that 83B election we talked about, right?
Okay.
The employee is really confident it's going to go up in value. You make the election, you pay your tax early, but then you get more capital gains downstream.
And on the other side of it is, if you make the election and it doesn't go well, what do we got, Fred?
Then you've got that angry employee who's muttering under his breath and blaming his accountant again.
Never heard that before. So let's look at the example here that's on this slide as well. So similar numbers to the previous examples. On this particular situation, we've got a director who receives an option to buy stock for $4. Whatever time it is, the option is exercised when the stock's worth 10. So the bargain element is worth 6, and which is taxable immediately, and any future appreciation becomes capital gain.
Right, and we're assuming there that when he exercised the option, or when she exercised the option, that it was either vested or deemed vested because the director made an 83B election, right? Either one.
Good.
Cool.
So, Fred, what's a 422 plan?
Well, employees were mad about the fact that they got given a stock certificate from their boss. There was a bargain element, but they had to write a check to the IRS when they didn't have any cash, right? If anything, they were short on cash because they had to pay their boss money to exercise. That's why, even though from the company's position, it seems like such a nice thing to give your employees stock, but from the employee's perspective, you're talking to me about all these really hard concepts, like I have to pay you money, but I may have to pay the IRS money also. To try to solve that, Congress created an incentive stock option plan. Now, this won't work for other service providers. It has to be an employee of the company. There are a bunch of other restrictions with respect to how much the employee can own of the company for it to be effective. But if you build it correctly, the incentive stock option functions just like the non-qualified. The economics are identical. However, if you meet all the tests for an ISO, then magically all of that bargain element, what we call ISO appreciation on slide 7, that winds up disappearing, meaning that you make believe for regular tax purposes the stock was still only worth $4 on the date of exercise. That's a really cool thing, because if the stock really was only worth $4, you have zero bargain element. What that means is you have zero ordinary income, no deemed bonus, and then all of the appreciation afterwards is capital gain. It sounds easy, but boy, those tests are hard to meet, Del, because in order to qualify, you have to hold on to the stock at least 2 years after the grant of the option and at least 1 year after the exercise of the option. That's really goofy, because it means you don't know for sure whether or not stock acquired under an ISO plan is incentive stock option stuff until you wait at least another year after the exercise.
So, I hate to call you on this, Fred, but I think I heard some weasel words in there. You were talking about this this bargain element not being taxable for regular tax. Well, what about the alternative minimum tax? And do we even care?
Well, unless the Trump administration kills off the alternative minimum tax, we care a lot. You're right. I used the weasel word saying that the ISO appreciation, that yellow box, is treated as being zero for regular tax purposes. But the alternative minimum tax comes in and says, wait a minute, if you got a bunch of really cool deductions or some kinds of income you exclude, we want you to pay at least 28% on whatever that income is. So that ISO appreciation has gotten a lot of employees really, really mad, because they think that what they're doing is just buying stock, and they think because it's an ISO plan, they shouldn't owe any income tax. The next April, their accountant hands them a form and says, sorry, that huge yellow box, that was all subject to AMT. And I've seen a few key employees in tech companies where the tax bill that they paid for their ISOs was more than the value of the stock a year or so later. So they were actually trapped into having to sell the stock and sell other assets to pay off their tax liability from the earlier year. So yeah, it can be pretty ugly if you get caught in that horrible trap of AMT income on an ISO and decline in value of the stock after your exercise.
I believe, editorial comment, folks, I believe Congress had no idea what they were doing when they put that particular piece in the legislation.
And I heard some weasel words there. You believe Congress had no idea what they're doing. Why would you add anything after that?
All right, exactly. Moving right ahead. Let's look at Section 4.
I apologize. Could I just go through the disqualifying disposition?
Absolutely.
So let's assume that we do have an ISO plan. And boy, the employer's really thinking, I'm going all out. Remember, the employer is giving up the right to any tax deduction on this ISO. So normally the employer would save, 30% or so, depending on their effective tax rate, on whatever that deemed bonus would have been. With an ISO plan, the employer is saying, no, I don't want the deduction because I don't want my employee to pick up that regular income. Darn it, the poor employee winds up paying AMT maybe anyway. If the employee sells the stock within that 2 years from grant, 1 year from exercise, that's called a disqualifying disposition. And then what happens is the ISO appreciation turns into ordinary income to the employee. Amazingly, it also creates an offsetting tax deduction for the employer. So we do see a lot of publicly traded tech companies where their tax benefit from disqualifying dispositions really saves a huge amount of tax for the employer. It's weird because it's the employee's decision to sell the stock, but when the employee does it, it actually gives a substantial tax benefit to the company.
So just a word out to you tax providers out there that are working with corporate clients. I don't suppose there's ever an issue with figuring out actually how much the disqualifying dispositions were in a given year so they can figure out what their deduction is. What's your experience there, Fred?
You know, there's good software now. I think in the old days it was just miserable to track all that, but now that pretty much everything is computerized, we have nice software that runs out reports and says, here's how much you need to pick up for GAAP purposes when you grant the options. Here's how much you need to pick up for tax purposes. Here are your disqualifying dispositions to give the employer the total amount of tax deductions that they get.
And so, folks, make sure your clients are doing good bookkeeping. Otherwise, they're not going to like having to figure that out.
Exactly.
Okay, so let's talk about Section 423 plans, employee stock purchase plans. Now, an employee stock purchase plan is funded with after-tax dollar from participating employees. So you hear the words participating employees. In other words, there's no rule that you have to participate. It's an optional plan that a company can put in place to again provide additional potential benefit to their employees. And the program will provide for situations where an employee can buy stock at a discount of up to 15% from the fair market value at the time that the purchase occurs, which is usually the lesser of the fair market value on the date of grant or the date of purchase. The discount is taxed as ordinary income when the stock is sold, and the remaining appreciation is taxed as cap gain as long as holding periods are met, which in this case is 2 years after offer date and 1 year after purchase date.
Right, a lot like the ISO plan, right, Del? Now, this is designed for rank and file employees, but it actually works reasonably well because unlike all those other plans we talked about, the employee can participate in a plan. They do have to pay tax on their money, and then what money is left over gets invested into the company. But they're making something right off the bat, meaning that their boss can sell them $100 worth of stock for $85. So unless the stock goes down by 15% or more, you're actually doing just fine by joining the plan. And then rather than doing something crazy like making you pay income tax the day you buy the stock, all the tax consequences are deferred until you sell. It's just that little 15% discount. That's like a bonus, but it's treated as ordinary income on the date you sell the stock. Most people are pretty comfortable with that, so I haven't heard a lot of people holler and scream about their ESPPs. I think most rank and file employees try to participate. My younger brother's in a plan with his company, and he's built up a decent amount of value in the plan over the years.
Okay. So how about that 15% amount? Is that something that the government's told us to do, or is there any flexibility on that?
All kinds of flexibility. You can price it anywhere you want. The maximum, as far as the government's concerned, is 15%.
So if you're working with a company that's thinking about this kind of a plan, there's flexibility on that particular amount. So let's take a look at the example that you see there on the slide. And on this fax, the situation is that the employee contributes to after-tax dollars to the plan. The plan then buys stock on behalf of the employee with the discount of up to 15%, depending upon whatever has been arranged by the actual sponsoring company. That discount is taxed as compensation when the stock is sold. Then additional appreciation is taxed as cap gain as long as the holding periods are met.
Right, so relatively clean, kind of similar to what we saw with the ISO, except for the fact that you maintain that ordinary income treatment. You don't worry about the AMT-ish stuff. You're going to have both ordinary income and AMT income with the ESPP discount, but the fact that you don't have to write a check to the government until you're selling your stock, people are generally pretty comfortable with the tax consequences of those plans.
Fred, here comes partnership profits interest. Take it away.
Boy, I'd be happy to. You know, we've talked about how challenging it is to give away a slice of equity in a corporate structure. Partnerships, you've basically got the same rules if someone gives ownership in a partnership. The vast majority of interests in a partnership are what are called capital interests, meaning that you own a share of the stuff. However, there is one category of interest in a partnership which magically go around all these rules. That's called a subordinated profits interest. How does the IRS define a subordinated profits interest? Imagine that the partnership sold all of its assets for their fair market value, paid off all the debts, and then liquidated. Would the service provider, the employee who's now becoming a partner, would they get a check for more than they had to pay in? If so, that's called intrinsic value, right? Because the stuff is worth more right now. But it looks down to the underlying value as opposed to the speculative value. In a corporation, you've got to include the possibility that things are going to go up in value. So if you think of intrinsic value, meaning what if we sold everything now and liquidated, would I get a check? And then speculative value, well, hey, whether I'm holding an option or a stock certificate, if any good thing happens in the next 5, 10, 15 years, I share in that good stuff. The partnership allows you to ignore that speculative value in deciding whether or not there's a bonus. Most private equity and venture capital and real estate partnerships all give the general partner a right to 20% of the cumulative profits. And those are usually structured to be a profits interest, meaning the GP gets to participate in future growth. Sounds an awful lot like a stock option, doesn't it, Dill?
It does.
And yet there's no income tax at all on the grant. You really don't worry much about vesting either, although we're looking for a pending change in the regulations that may require partners who receive unvested partnership interests to make an 83B election if it's a profits interest. Instead, what happens is you get a K1 every year. If that K1 shows you some income, you pay tax if and when that comes through. And then when you sell your partnership interest, anything you get over your basis in the partnership, that would also be gain on the sale of a partnership interest. So the employer doesn't get a deduction with a profits interest, but man, it sure gives a nice result. It's a good way to bring people into a service business, and you and I have both seen that with Big Four firms, right?
Yeah.
Routinely admitting partners
Right.
and saying, sorry, you only get a share of the residual if good things happen in the future.
So, Fred, I see the slide talking about potential law change under Notice 2005-43. Well, under my math, that's 12 years ago. There's not any controversy on this, is there?
It's a government project, so much like the Grand Canyon, it's going to take a long time. But yeah, we've been waiting a long time for these proposed regs to come out. There have been other things that have occupied the government. So for the moment, we still use the old rules, which were under something called Rev Proc 9327 and 2001-43. Those rules are relatively clean. Everybody understands them. We just want to make sure that we're letting our clients know that anytime in the next couple of years, we may see a substantial change in how profits interests are treated, and we ought to be redrafting our partnership agreements now in anticipation of the whereases that will get put into the regulations after Notice 2005-43 finally takes effect.
Folks, that's pretty much the end of our presentation. Does this sound good to you? Is this interesting to you? We're here every day. Give us a call. Come on by. We are looking for you to send your students, send your employees to be our students. We're looking for you to be and join us as well. Fred?
Thanks very much.
And you.